Hello and welcome to this Chemical Conversations podcast brought to you by Argus Media. In this edition, we'll be sharing global ethylene market recap ahead of EPCA's annual conference in Berlin next week. And we're going to go around the regions with an overview of the current market situation and then reflect a little bit on the short-term forecast. I'm Sarah Ray, VP Olefins and Derivatives, sitting here in Europe, and I'm joined today by Becky Zhang, our lead methanol and olefins consultant in Asia, and Craig Barry, our lead consultant for ethylene derivatives in Americas. So, starting with the current situation, Craig, the US has been through a really unusual few months with low ethane costs while ethylene prices have been elevated. Can you talk us through a little bit of why that happened and has it normalized now?
Yeah, thanks, Sarah. The recent market forces that have led to higher ethylene and at the same time lower ethane prices are really not related. I'm going to look at ethylene first. The U.S. ended first quarter with ethylene inventories 14% higher than the prior year. But since the beginning of May, cracker reliability has been extremely poor. Also, the impacts from Hurricane Beryl have contributed to production losses. The situation peaked earlier this month with about 14 to 18% of cracker capacity offline, and we have already seen spot ethylene prices move sharply downward as the industry operations have returned to normal levels. For ethane, prices started to decline in June and July as ethane production increased with higher recovery from Permian Basin natural gas plants. U.S. ethane exports are already near infrastructure limits, so this put pressure on ethane stocks. The Permian Basin was long natural gas due to pipeline constraints, and when this occurs, NGL producers recover incremental ethane from residue natural gas streams. So producers can ship more methane to market demand hubs. The Matterhorn Express natural gas pipeline started up earlier this month, so we're already starting to see ethane prices recover to their June price levels. Becky, where are operating rates and margins currently in Asia?
Hi, Craig. Asia cracker operating rate has already reached the year's highest level of about 84 to 85% in September, compared with the year's average about 82%. We have seen a slew of cracker shutdowns have recovered in Southeast Asia. The region's operating rate reaching also the year's higher of 77% now. And except the ongoing turnaround at ExxonMobil's cracker in Singapore, the rest have all returned to normal operations. And in Northeast Asia, the cracker operating rate had been steady around 84-85% since late May. They only fell briefly in mid of August to 82% after some unplanned plant outages in Japan and China. On margins-wise, both naphtha and propane-based cracker margins improved slightly this year compared with the previous 2 years, although they remained negative and still lower than the pre-2022 level, but it's improved slightly to negative 120 for naphtha cracker margins this year, compared with negative 190 last year and negative 240 the year before. Propane margins have also recovered slightly higher than naphtha cracker margins to about negative 110 this year. You may ask me why the operations and margins are higher this year. Well, the cracker expansions actually in this year have been taken a break. There is some delays of the Chinese new cracker expansions to next year, and there was the lack of supply from the US and the Middle East as well. So those have lent a major support to the Asia cracker margins and the ethylene prices as well. The overall demand is still showing weakness, but they are still growing at moderate rates. But that could have lent limited support, really. Okay, Sarah, we have seen higher prices and spreads in Europe in September. What has driven that, and will that last?
September in Europe was a bit of an outlier, really, in the sense that, ethylene was short because of planned and unplanned outages. There was limits to the import of product, which you'd normally see in Europe when there's maintenance, and for reasons that Craig has already explained. And feedstock prices fell at the same time. Unfortunately, it's unlikely to last. The unplanned outages have largely restarted now, and although maintenance is ongoing, a lot of that is limited within Germany, so it's affecting the German market, but the coastal market has recovered pretty much to where it was before. Europe is really struggling in terms of the demand profile. And the amount of operating rate has been probably averaging this year a bit better than 23, but not a lot better. So, still maybe the mid to high 70s in terms of an average operating rate for the year. And Europe still has two crackers off on long-term issues. So it's still, from a supply point of view, Europe is nowhere near where it was back in 21 and 22. And looking forward in the very short term, people are already looking towards year end from a stock reduction perspective. So Craig, back to the USA with the election just around the corner. What do you expect for the rest of the year and into 2025?
Well, Sarah, let me address what I expect before I go to the election, because that's turning out to be a very interesting development. Really before the operating issues that we saw in second and third quarter this year, spot ethylene and even ethane were trading in a range. For ethylene, it was around 18 to 22 cents per pound, and for ethane, it was notionally around 20 to 25 cents a gallon. I expect prices to kind of return to these levels as operations and everything normalize no later than the end of first quarter 2025. The U.S., given its cost position, really has been operating at a pretty steady rate, not really up or down, aside from operating issues. And I expect that to continue. We really don't see a whole lot of new capacity coming on in the U.S. in 2025. There is some discussions, or we have identified at least one significant derivative unit, polyethylene train, coming on by the end of the year, but that's probably going to have more of a 2026 impact. So I think directionally, a lot of things in the U.S. are going to be more of the same, unless there's really a return of growth somewhere like in Asia, or perhaps if there was a downturn in the U.S. And neither one of those scenarios are really forecasted at this time. Now, turning to the election, I don't really expect the election results to have really an immediate impact on the industry in 2025. It really takes the incoming president really until about middle of the year to get organized once they're sworn in by, say, June 20th. And a lot really depends on who controls not just the White House, but both houses of the Congress as well. It's very difficult for either party to enact any significant legislation unless they control the presidency in both houses of the Congress. Now, saying that, I know there's been talk about across the board tariffs by one candidate. But I think the thing that's not mentioned a lot is that when the U.S. did enact tariffs back in 2018, China also enacted tariffs that had a significant impact on U.S. farmers and ag products. And the U.S. government had to step in with $20 to $40 billion of aid to support U.S. farmers. I think at a time when people are dealing with a lot of inflation on food, I think that's probably more political rhetoric than what we'll see as policy, especially in 2026. So I think it's going to be more of the same. I think regardless of who wins the election, that their policy options and things that they're going to enact are pretty narrow, given some of the issues the U.S. have to address that are not necessarily related to our industry. And with that, in Europe, Sarah, do you anticipate any major changes in the markets?
Yeah, interesting question, Craig. I don't think we expect major changes from a European perspective in the markets. We're seeing, a really slow economic recovery. The pressures from an economic perspective in places like Germany, who are suffering significantly higher energy costs than they were pre the invasion of Ukraine by Russia. And that means that it's much more difficult for that economy to recover. It is less able to export its products and its finished products than it was previously. So I think that economic recovery is going to take time. There's also pressures from a European perspective from the logistics costs. So Europe got some benefit through 2024, particularly in that first quarter, from the closure almost of the Red Sea and the much higher logistics costs to bring product in from Asia. Those logistics costs are beginning to come down. We don't expect them to come off a cliff, but they're certainly beginning to come down. So, those import pressures will grow. On the positive side, I think Europe's going to end the year with incredibly low stocks. And what that means is that come the beginning of 2025, there'll be a significant flurry of activity as both producers and some of the derivative streams need to get themselves back up to a working stock level from the empty warehouses they're going to have come year end. So I think, as always in the European industry, there's a seasonality to it. So the first quarter, the first half will maybe feel better, even though the underlying situation may not actually be a bit better. And I think the longer term, if we talk about the elephant in the room, and the longer term elephant in the room is the CO2 reduction targets in the European market. So is the EU government going to, and Commission and authorities going to announce a CBAM, a carbon border adjustment for chemicals at some stage? And what impact will that have? But that's not going to impact that for next year. That will take longer to come into place. So yeah, nothing really hugely significant. So I think in that short term, just a slow recovery. And Becky, over in Asia, the same to you. What are you anticipating for the rest of this year and into 2025?
Yeah, I think now the ethylene prices in China has been softening in the past 3 weeks because supply was ample and demand was subdued. But looking forward, we are just really expecting some price rebounds. One is because turnaround are getting more in October. There are 3 Chinese crackers, 1 South Korea cracker, and 2 Southeast Asia crackers are poised for turnaround in October, November, and that will help to reduce the surplus in the market. And the other thing, maybe you have also noticed in the past week, Chinese stock market soared from 2,800 to 3,200 just in a week. And even just today, the Shanghai stock market has gone up by 8%. So that has really driven up the market sentiment, and that could eventually increase the demand and in terms of the consumer spending confidence. And housing market also might see some recoveries eventually. So that will all drive up the chemical consumptions towards the end of the year. But in the longer term, Asia, particularly in China, we are still under massive construction of new cracker projects. We have 2 cracker projects delayed to next year. So in total, we will see 6 new crackers totaling 8 million tons of ethylene capacity to start up next year. And another 7 new crackers starting up in 2026, bringing up a total of 9 million tons new ethylene capacity. And the year after, another 8 new crackers, totaling about 10 million tons of new ethylene capacity. So not only China, there are also new crackers in Southeast Asia, Indonesia, India, and Korea. A few of them, they will bring about incremental ethylene merchant supplies because downstream capacity expansions are lagging compared with ethylene. So with all of the new huge expansions going ahead, we are expecting the down cycle in Asia's ethylene industry to prolong. And the overall operating rate is likely to fall to even below 80% during the period 2027-28 before correction toward the end of the decade. And the downstream capacity operating rate is likely to be even lower than the cracker because we are seeing a severe overcapacity in PE, MEG, styrene monomer, PVC sectors in the coming year. Yeah, that's very much for Asia.
Wow, Becky, obviously a lot to watch. And I just want to say a big thanks to Becky and Craig. Thanks for sharing your insights. Huge number of factors to bear in mind and for us to be watching and sharing with our clients as we move forward into EPCA and beyond. So thank you very much, and thank you all for listening. For more information about our olefins market coverage, or if you'd like to meet us at EPCA, please get in touch via the website. Thanks for listening.